Welcome to TalkTickers. You're looking for a shortcut through BANR Corporation's latest earnings call, and well, that's exactly what we're doing today.
Yep, we've dug into their first quarter 2025 report.
We've boiled it down to the essentials, the key numbers, what management's really thinking. Let's just dive right in.
Okay, so for Q1 2025, BANR reported net profit for common shareholders, $45.1 million. That works out to $1.30 per diluted share.
$45.1 million. How does that compare?
Well, it's interesting. It's a big jump from the $19 million they posted in Q1 last year.
Okay, big jump year over year.
Right. But it's actually a slight dip from the last quarter, Q4 2024, which was $1.34 per share.
Okay, so up year over year, down quarter over quarter. What about their core earnings?
Core earnings looked pretty solid. They hit $59 million for the quarter.
And that compares to?
$53 million a year ago. So decent growth there.
All right. And revenue from those core operations?
That came in at $160 million. Compare that to $150 million in the first quarter of 2024.
So revenue up too. And return on assets?
Return on average assets for the quarter stood at 1.15%.
Okay, so a bit of a mixed picture on the headline profit, but core earnings and revenue moving up year over year. What's really driving the financials underneath all that?
Well, a really key metric, especially now, is their net interest margin, their NUM.
Right.
And that actually increased. It went up 10 basis points to 3.92%.
Oh, that's pretty strong in this environment, isn't it? What's behind that rise?
It seems like good asset liability management. It came from two sides. Higher yields on their earning assets, so making more on loans and investments, and lower funding costs.
Okay, so making more, paying less.
Basically, yeah. Their loan yields went up partly because adjustable rate loans repriced higher, plus new loans they originated came on at an average rate of 8.01%. Pretty healthy.
Right. Yeah.
And on the other side, their deposit costs actually fell, which helped lower those overall funding costs.
Okay, and speaking of deposits, how are they looking? Stable.
Seems like it. Core deposits are still, the vast majority, 89% of total deposits.
That's a high percentage.
It is. And those core deposits saw a 3% increase compared to last year. Overall, total deposits grew by about $79 million in the quarter.
That suggests customers are sticking around.
Yeah, that stickiness in core deposits is generally seen as a good sign. Customer confidence, maybe?
Okay, now what about the other side? Lending. Are they putting money out the door?
Yeah, loan growth was positive. They saw 5% growth year over year.
5%.
And 3% annualized growth just within the quarter itself.
Well, where's that growth coming from mainly?
It's primarily driven by construction and development. So think multifamily housing, land development, commercial construction,
right,
that sort of thing.
Interesting. What about other areas like regular business loans?
That's where it's a bit different. They actually saw a slight decrease in their commercial and small business loan balances. Management said that was mostly due to paydowns.
Okay, so growth in C&D, but maybe some caution or paydowns elsewhere.
Got it.
How did the rest of the income statement look? Non-interest income.
That actually went down this quarter.
Oh, why was that?
The main reason was that the previous quarter, Q4, had included some gains from loan sales. That didn't repeat in Q1.
Ah, okay. So a one-off boost last time that wasn't there now?
Yeah.
Makes sense. What about expenses?
Non-interest expenses increased. The main driver there was higher salary and benefit costs. Pretty common story these days.
True. Okay, let's pivot to credit quality. This is always, top of mind for anyone looking at a bank. What's the story there?
Right. And here we do see, a bit of movement. Delinquent loans borrowers falling behind, they increased.
How much?
They ticked up to 0.63% of total loans. Now that's up from 0.49% at the end of last year and 0.36% a year ago.
So a noticeable upward trend there.
Yes. And similarly, adversely classified loans, those are loans where there's more concern about repayment, also saw let's call it a modest increase. They reached 1.73% of total loans.
Okay. And non-performing assets overall?
Those also saw a slight uptick to 0.26% of total assets.
So a general slight deterioration across those metrics. What did management say about that? Does it concentrate it anywhere?
They pointed mainly to the higher interest rate environment, just putting more pressure on some borrowers.
That's understandable.
But they did emphasize that these adversely classified loans are pretty granular. The average commitment size is under $1 million, and they aren't seeing a big concentration in any one sector.
Okay, so spread out, not one big problem area.
Exactly. And importantly, their cushion, the reserve for credit losses, that remains quite robust. It's at 1.38% of total loans.
Okay, so they have provisions set aside. Now, what about making new loans? You mentioned growth overall, But were originations strong in the quarter?
Actually, no. Loan originations were down pretty significantly, about 33% compared to Q4.
Wow, 33% drop quarter over quarter. Where was the slowdown?
Mostly in commercial and commercial real estate lending.
And the reason?
Management put that down to, well, client uncertainty about the economy, people holding back a bit.
Right. But are they seeing signs that might change?
They did say their pipelines, potential deals in the works in those same sectors are actually growing. So it suggests things could pick up again if, that uncertainty lifts a bit.
Okay, potential for a rebound later. Let's move to what the folks running the show said. Management commentary, outlook. What were the key messages?
They touched on a few specific headwinds in their footprint. They mentioned negative impacts from recent immigration enforcement activities.
Really?
And also reduced Canadian border crossings. They said that's particularly affecting agriculture and tourism clients.
Interesting regional factors there. Anything else on the macro front?
Yes, tariffs. They expect the recently enacted tariffs to negatively affect West Coast businesses, especially the smaller ones, and consumers too.
Okay, so acknowledging some economic challenges.
Definitely. But they also stressed that the full impact, well, it's still uncertain, hard to quantify yet.
So given those headwinds, how do they view the bank's position? Are they battening down the hatches?
They emphasize they're sticking to a moderate risk profile. They believe the balance sheet is strong. And importantly, their capital is well above regulatory minimums.
And still aiming for loan growth this year?
Yes. They reiterated their target for mid-single-digit loan growth for the full year.
Okay. And how are they thinking about using their capital? Dividends, buybacks, debt?
Priority one is the core dividend. They mentioned potential increases over time there.
Standard playbook.
Right. They're also actively looking at $100 million in subordinated debt they have, because that's about to switch to a variable rate in July. So they're evaluating options there.
Makes sense. Buybacks.
Under consideration, they said, but not a current priority. Seems like managing that sub-debt and the dividend are higher up the list right now.
What about M&A? Still looking.
They said conversations continue, but the market volatility right now, it's making them cautious. So maybe less likely in the immediate term.
Okay. And their outlook on that key profitability metric, the net interest margin.
Generally positive. They suggested it could potentially expand more if the Fed either pauses rate hikes or, gradually starts cutting rates.
But what if rates fall fast?
They did add a note of caution there. A significant rapid drop in rates could actually pressure the margin.
Right. The asset sensitivity comes into play.
Exactly. But they also mentioned historically BANR has operated with a NIM over 4%. And management sounded, fairly confident they can get back towards that level under the right conditions.
And other guidance points. Expenses, taxes.
They basically said the expense run rate from Q1 is a reasonable expectation for the rest of 2025. And the tax rate in Q1 is probably a good indicator for the full year, too.
Okay. Any color on fee revenues?
Yeah. Deposit fees were down a bit, but they saw an increase in gains on loan sales, specifically from their SBA business line.
And mortgage banking.
That's expected to be driven mostly by, interest rates, as you'd expect.
So summing up management's view, they see an economic slowdown coming, maybe worsened by tariffs and uncertainty.
Correct, but they also think BANR is pretty well positioned. They even mentioned potentially gaining market share because of disruptions happening among some competitors.
Interesting. Any bright spots regionally?
They did call out defense spending in the Puget Sound and San Diego areas as something that could potentially support those local economies.
Okay, so navigating complexity, seeing some specific risks, but also potential opportunities. For someone trying to make sense of all this, what are the really crucial takeaways from this call?
Well, first, that net interest margin increase. Managing to grow NIM despite everything else. That suggests pretty effective management of their balance sheet. That's a definite positive.
Right.
Second, the loan originations being down is a concern, sure, but those growing pipelines in commercial lending offer some hope for future growth if the economy stabilizes.
So keep an eye on pipeline conversion.
Yeah, exactly. Third, credit quality. Yes, there's a slight uptick in delinquencies and classifieds, but the levels still seem manageable, especially with that strong reserve backing them up. It's not flashing bright red yet, but definitely something to monitor.
Okay. Manageable, but needs watching.
For sure. And fourth, You have to factor in management's cautious economic outlook and those specific warnings about tariffs hitting their West Coast footprint, particularly small businesses and agriculture. That's a key risk factor.
Absolutely.
And finally, their focus on capital strength and managing that upcoming sub-debt maturity shows they're thinking about financial flexibility and risk management.
Okay, that's a great summary. Now let's get to our favorite part, the "this is not financial advice" segment. We brainstormed some, let's call them creative but maybe plausible trade ideas. Based on BANR's call, what thought experiment comes to mind?
Okay, well, look at BANR's strong core deposit base, right? 89%. And management sounds kind of hopeful about getting that NIM back up, maybe towards 4%, especially if rates stabilize or gently fall.
Yeah.
So one idea, purely hypothetical, of course, might be a long position in BANR Corporation itself. The thinking is the market might be underappreciating their ability to hold or even grow net interest income, especially if loan demand does pick back up later this year, like they hinted. It could be a relative strength play within regionals.
Okay, long BANR based on fundamentals, but maybe there's a hedge or an alternative.
Right. Now, consider the flip side. Management specifically flagged those tariff risks for West Coast businesses.
Yeah, the small businesses, imports, exports.
Exactly. So a more contrarian and definitely riskier idea. Maybe explore short positions, not in BANR, but in a basket of publicly traded companies that are really heavily reliant on trade through West Coast ports. Think logistics, maybe specific import-export businesses.
So isolating that macro tariff risk.
Kind of. The idea is you're betting that if the tariffs do bite hard, those trade-dependent companies suffer, potentially offsetting some risk or even profiting, while hoping BANR's specific strengths let it perform better than those directly hit companies.
Interesting. So long BANR on its strengths, maybe shorting the tariff impact via other companies.
It's a complex thought, definitely higher risk on the short side, very dependent on how severe those tariffs actually become. Again, just an idea to mull over, absolutely not advice.
Definitely not advice. Food for thought only. Okay, that wraps up our deep dive into BANR Corporation's first quarter 2025 earnings call.
We pulled out what we thought were the key insights to keep you ahead of the curve.
And remember, those trade ideas are purely illustrative brainstorming. Please do your own thorough research and due diligence.
So what did you think of BANR's report? Anything stand out to you? How do you see those tariff impacts playing out for regional banks?
Let us know what you think. Thanks for tuning in to TalkTickers. We'll catch you on the next crucial earnings breakdown.